What are the most effective technical analysis charting patterns? How can they be used to make you money when trading? Welcome to this episode of Ahead of the Trade. Today, we are going to be exploring some of the most popular technical charting patterns that occur on all time frames and in all different trading markets. We are going to explain exactly what each of these chart patterns look like and how we can identify them in real time. We are going to cover whether each of these patterns is usually bullish, bearish, or neutral, and how that might affect your trading bias when you see them forming. We'll also explore the importance of trading volume as a vital factor within all of these patterns and where we should anticipate it increasing and decreasing. Finally, we will walk through some of the ways in which you can effectively trade based on each pattern. We'll discuss where to enter a position and provide logical places to set your stop loss depending on your level of risk tolerance. I have also made a technical chart patterns cheat sheet which you can download for your own use. The link is in the description. Before we begin, I think it's worthwhile covering a few quick definitions of terminology that I will be using throughout this video. The term bullish is used to describe a scenario in which we expect price to go higher. Bearish is used to describe when we expect price to go lower. Going long, or entering a long position, means we are looking to buy, to enter our trade, and we anticipate price going higher. Going short, or entering a short position, means we are looking to sell, to enter our trade, and we anticipate price going lower. It is also important to note that no chart pattern has a 100% rate of success. As is the case with all of the following charting patterns, or any trading strategy for that matter, there is no assurance that we are ever going to experience a winning trade. What these chart patterns offer us are scenarios in which we have the odds in our favor and we have a higher probability of one outcome occurring over another. When we have the probabilities in our favor and we act with consistency, we can expect to profit over a series of many trades. Even though these patterns generally offer us an idea of whether to expect price to move higher or lower, we need to be flexible and ready to make trading decisions based on the resulting price action, not what we think should happen. Now we are ready to begin exploring some of the different technical charting patterns. The first chart pattern that we are going to discuss today is called the ascending triangle. Here is an example of what an ascending triangle looks like on a chart. As the name suggests, the ascending triangle looks like a triangle with a horizontal resistance level and an ascending line of support. These patterns can be identified with ease and are a rather beginner-friendly charting pattern to see. It is typically a continuation chart pattern, which means we anticipate price breaking out in the same direction as the trend, which was taking place prior to the formation of the triangle pattern. When anticipating going long, based on an ascending triangle chart pattern, such as in this example, we want to see an increase of trading volume immediately before and during the anticipated breakout through the horizontal resistance level. Without the volume behavior, we will have a far lower rate of success from trading this pattern. We shall anticipate a breakout event to occur as the support and resistance lines continue to converge. It is important to understand that the breakout can occur before price reaches the apex of the triangle, as has happened in this example in Tesla. The way in which you may wish to enter a position based on this particular pattern is to buy when price breaks out above the resistance level with a stop loss set below the line of resistance or more conservatively, below the line of support. However, it is not uncommon for an ascending triangle to break down, and for this reason, we need to be ready to trade in either direction based on the resulting breakout and with volume confirmation. The next pattern that we will cover is called a descending triangle. Here is an example of what a descending triangle looks like on a chart. This pattern is the inverse of the ascending triangle. In this case, we have a horizontal level of support with a descending line of resistance. Price is consolidating lower and tighter to the support level as the pattern develops. A descending triangle is generally a bearish continuation chart pattern. We can confirm that this is a bearish descending triangle forming due to the increase of volume traded as price breaks below the support level. When we identify a descending triangle, we may decide to enter a short position as price breaks below the level of support. A logical place for our stop loss, as per this example, would be back above the support level that we are basing our short entry from. A more conservative option for your stop loss would be to set it above the line of resistance. Just like the ascending triangle pattern, we need to be ready to trade in either direction based on the price and volume behavior. This next chart pattern is called the symmetrical triangle. It is a combination of both the ascending and descending triangle. The way that we can identify a symmetrical triangle is due to its descending resistance line and an ascending line of support. This pattern is not necessarily either bullish or bearish. Instead, there is a rather even possibility of a breakout in either direction. As a general rule, the more common direction for the breakout to occur will be in the same direction as the general trend of the market. A useful tip for determining the current trend of the market is to examine the direction that the 200-period moving average is currently pointing. We can also use multiple timeframe analysis techniques. We will cover multiple timeframe analysis in greater detail in another video. As is the case with all of our triangle patterns, we expect to see volume increase as price is squeezed by the converging support and resistance lines in anticipation of a breakout. The way we trade a symmetrical triangle is to either go long or go short based on the direction of the breakout. Our stop loss in this example shall be positioned either below the resistance line or more conservatively below the line of support. This next pattern is one of the most popular and my own personal favorite. It is called the bull flag. This is what it looks like on a chart. Bull flags are most commonly found on charts that have had a very sharp upward move in price, followed by a lower volume consolidation, often with a slight pullback. The shape of this pattern represents a flag on a pole. The flagpole is formed by the sharp move higher in price, and the flag is formed by the consolidation pattern. The consolidation of the flag is typically angled lower on the chart. This is a very bullish pattern and can offer some excellent trading opportunities to go long. The volume traded plays a very significant role in this pattern. For it to be confirmed as a bull flag, we must see sharply increased volume for the flagpole part of the move, followed by significantly reduced volume during the consolidation. We want to buy as volume begins to pick up again and price breaks out of the consolidation range, anticipating a continuation move higher. Our stop loss is generally placed below the lowest point of the consolidation pattern. Bull flags often will happen in sequence, one after another, sometimes up to 4 times in a row, in markets that are trading on exceptionally high relative volume. It is important to note that each consecutive bull flag will have a lower probability of a successful resolution and higher chance of triggering your stop loss. For this reason, I personally will only trade the first 2 bull flags to happen in a sequence and only when I have confirmation of the pattern due to the volume behavior. The inverse of a bull flag is called a bear flag. This is what a bear flag looks like on a chart. We have a sharp move lower, followed by a lighter volume consolidation rally. As the name suggests, this is a bearish pattern, and when we see it, we shall usually anticipate a continuation move lower. Just like a bull flag, we need to see significantly lower volume traded during the consolidation period of the pattern. We want to enter a trade short when we see volume increasing and price break downward past the bottom of the consolidation range. Our stop loss when trading bear flags shall be set above the highest point of the consolidation range to ensure we do not get shaken out of our position unnecessarily. Just like bull flags, bear flags will often form in sequence of 2 or more in a row. This is called a wedge pattern. Like triangles, wedges can come in both ascending and descending configurations. Unlike ascending and descending triangle patterns, wedge patterns have no horizontal support or resistance lines. The support and resistance lines tend to run near parallel with one another, aiming either higher or lower on the chart. Wedge patterns will more often result in reversals of price. This means that once the pattern finishes consolidating, an ascending wedge will tend to break down lower and a descending wedge will tend to break out higher. Similarly to all of the patterns previously discussed, we look to see a sharp increase of volume as price breaks out either higher or lower from the wedge. This high volume price move will confirm the directional bias of our trade entry. Our stop loss is set to be triggered if price re-enters the wedge consolidation or more conservatively, set on the opposite side of the consolidation pattern altogether. This is called a double bottom pattern. An easy way to identify a double bottom is to look for a W shape on the chart. Double bottoms are a sign that price was unable to break through a specific support level on 2 separate occasions, and the result is generally price moving higher. Double bottoms are a bullish chart pattern for this reason. The opposite of a double bottom pattern is called a double top. Double tops look like an M shape on the chart. Double tops signal that price was unable to break through a resistance level after 2 separate attempts, and the result is generally price moving lower. Double tops are a bearish chart pattern. When identifying double bottoms and double tops, we want to see an increase of volume as price comes into and is rejected by the support or resistance level. It may be easier to identify this volume behavior on a lower timeframe chart. Double tops and double bottoms are reversal patterns, and we trade them accordingly. We look to either go long after a double bottom pattern has formed or to go short after the resolution of a double top. Our stop loss will be set on the other side of the nearest support or resistance level, depending on the directional bias of our trade. Here, we have a head and shoulders pattern. These patterns often signal the end of a bullish price trend. To identify a head and shoulders pattern formation, we look for a high, the first shoulder, followed by a higher high, the head, followed by a lower high, the second shoulder. As can be seen in this example, a head and shoulders pattern is a bearish chart pattern and is more likely to result in price moving lower with bearish momentum. The opposite of this is called an inverted head and shoulders pattern, which is a bullish pattern. It is identified in the same way as a regular head and shoulders pattern, but inverted. We can look to enter either short or long based on whether we are trading off a head and shoulders or an inverted head and shoulders pattern after the resolution of the pattern has been confirmed. This confirmation is given when the second shoulder has been formed and price is beginning to move away from this level. We look to enter as price passes through the neckline with a stop loss on the other side of the shoulder, as is shown in this example. Not all technical chart patterns take a whole series of candles to resolve. There are price action patterns that can play out in a single candle. As is the case with any charting pattern, price action candles should not be relied upon solely as signals to enter or exit a position. They should instead be combined with additional technical indicators and with support and resistance price levels as part of a trading strategy. See some of my other videos for further explanation on this topic. Here are a few examples of some of the most powerful price action candles to look out for. This is called a hammer candle. It can be identified by its short body and long lower wick. Whether red or green, a hammer candle is often a sign of bullish strength. The hammer candle tells us that although price did move lower during the course of the time period for which the candle represents, the lower prices were rejected and buyers entered the market, pushing the price back up towards the higher prices which the candle opened at. Hammer candles are generally not a great trade entry signal on their own, but can be very useful when combined with other technical indicators and variables for additional confirmation, such as areas of support and resistance or the stochastic indicator explained in a previous video. This is called a shooting star candle. It is the opposite of a hammer candle. It has a long upper wick and a small lower body. Whether green or red, a shooting star is usually a bearish signal. Shooting star candles often signal the top of an uptrend or the beginning of another move lower in patterns such as the bear flag, as shown in this example. Shooting stars can make for great short trade entries when they form immediately below a resistance level, when confirmed by other technical indicators, or when observed as part of a charting pattern. The next price action candle that we are going to discuss are called DOJI candles. Dojis are unique because the price that the candle opens and closes at is either the same or very similar. They look different to other candles because they have a very thin body. The wicks of the doji candle signal to us what we might expect to happen next. If there is a long wick on the bottom of the doji and the open and close are toward the highs, we treat it like we do a hammer candle. If there is a long wick on top of the doji and the open and close are towards the bottom, we treat it like a shooting star. If the doji has roughly equal length wicks on the top and bottom, this is a sign of indecision, and we must wait for further confirmation before making any trading decision. Here, we have a bullish engulfing pattern. A bullish engulfing pattern is identified by a green candle that completely engulfs the previous red candle. As you can see here, this green candle has opened below and closed higher than the previous red candle. This is a strong bullish signal. Conversely, this is called a bearish engulfing pattern. A bearish engulfing pattern is a red candle that completely engulfs the previous green candle. As you can see here, this red candle has opened above the high of the green candle before it, and it completely engulfs the whole green candle, closing significantly lower than the green candle opened. This is a strong bearish signal. Once again, I want to reiterate the importance of not making any trading decision based on a specific price action or candlestick pattern alone. We must consider other factors such as support, resistance, and other technical indicators before deciding whether we are going to enter or exit a trade. When implemented correctly, all of these patterns can be extremely useful pieces of a trading strategy. We must not forget the importance that volume plays in all of these technical patterns and must understand that without volume increasing and decreasing in the right places, the pattern is not complete. When trading, we must only enter on the highest quality of setups where all of the variables suggest that we have a greater chance of experiencing a winning trade. These setups are identified by confluence between technical indicators, charting patterns, and price action. I hope you now have a far greater understanding of many different technical charting patterns and how you may trade them within an encompassing trading strategy. If you would like to further support the channel and have a sneak peek at our behind-the-scenes notes, as well as a few other perks, we would greatly appreciate you becoming a Patreon supporter. I have left a link in the description. If you have found this video to be helpful, consider giving it a thumbs up and subscribing, as it will help the video get recommended to others by the YouTube algorithms. Make sure you let us know in the comments what trading topics you want us to cover next. See you next time on Ahead of the Trade.